Hey, and welcome to another video here at Fiscal Voyage. I'm Felix. And first off, make sure hopefully you guys are all safe and healthy. Make sure you wash your hands during this pandemic. During this pandemic, the stock market has been dropping tremendously. It looks like it's been stabilizing now, but we find a lot of companies that are still somewhat overvalued or fairly valued, and a lot of other companies that are undervalued. So, and in this video, we're going to talk about Illinois tools work. We're going to find out if do a stock analysis if this company is a buy, hold, or sell at current prices. So let's get to it. Okay, here's a stock analysis on Illinois tools work. Could be found in the New York Stock Exchange as ITW. The company is an American Fortune 250 company that produces, engineer fasteners and components, equipment, and consumable system and specialty products. It was founded in 1912 by Byron L. Smith. Um, some of the products and solutions that they provide is all over the world. In some field in deep sea oil rigs, aerospace technology, bridges, wind turbines, healthcare, spaces, and places where we live and work. The cars we drive, the mobile devices we rely on. So there, a lot of the products is everywhere. So it's a very diversified company here, which I like. Let's look at the fundamentals. Revenue grew at a compound rate of negative 1.3% from 2010 to 2019, which is not great. So basically, revenue has been on a decline since. However, the past 5 year average has seen an increase of 1.3%. So the past 5 years is a little better than the 10 year. Net income grew at a better rate of 5.7% from the 10 year period. And in the past 5 year is much better at 7.3%. So net income has been growing in the recent years, and they have an outstanding credit rating of A plus, which is great. So the risk here of bankruptcy or dividend cuts is very low. They have a great credit rating. Operating income just grew at a little better rate over revenue at 4.2% from the 10 year period, and earning growth in this 10 year period has been 10.8%, which is much better than the net income and revenue. So it's kind of one of those, it's like it's not how much you make, it's what you use it for and how profitable it turns. Um, and earnings 5 year average has been the same rate for the past 10 years, which is 10.8%. If Let's continue with the fundamentals. 2019 they had earnings of $7.73. Net margin came in at 17.9, which was expanding compared to 2018 of 17.4, a slight expansion, which is still good. Return on equity is a whopping 80.3%, which is outstanding, and they've been increasing that for the past 5 years as well. So return on equity is great at 80%. They are a little high on debt at 71% to capital. So that is pretty high here at 71%. Current yield is a little low at 2.82%, but it is higher than their 5 year average of 2.16, but not tremendously. It looks like about 60, 70 basis point. So it is higher, but we'll look at this further. They have a high payout ratio of 73.2%, so that's something to be a concern of here. But they've been growing dividends for a whopping 45 years consecutively, so that's outstanding. And they have a 5 year dividend growth rate of 18.5%, which is great. And their most recent dividend increase was 7% in September of last year, so that's outstanding. Um, so they have a charter rule of 21, which is the 5 year growth rate plus the current dividend yield, which is great. I like this. The charter rule is basically seeing companies 12 or higher, which is a nice indicator that it's good time to research further. Um, let's look at future outlook. 2020 is expected to earn $6.04, which is much lower than the $7.73 they earned last year. And of course, this is because of the pandemic of the coronavirus, business shut down, people are not spending, companies are not spending, cutting capex, things of that nature. So that's dropping the earnings to $6.04. But it looks like they're going to pick up at 2021. Analysts expect at $7.18. And CFRA has projected 3-year earnings growth of 7% going forward from here. My dividend yield return model projected total return of 9.4% annually. So that's a pretty decent rate of return considering this environment. But you could find a lot of companies that have higher projected total return, you know, in the 13, 14, 15%. So that's something to consider here. Currently, the company has a PE of 21 with a forward PE of 25 based on 2020 earnings and a 5-year PE average of 22. So that right there is a good indicator that the company is either fairly valued or a little overvalued with the PE here. So we look at the fast graph. The black line is the monthly closing price. The blue line is the normal PE of 20.5, and the orange is the normal PE earnings of a PE of 15. So you can see here the company tends to follow the blue line, which is the normal PE of 20, and currently with the blended PE of 21 at current prices. So, and then you see here as the 2020 estimate of $6.04. So that's an indicator that the price can be dropping or just staying flat because it is a high quality company. But it's a good indicator that it's about fairly valued to slightly overvalued here. So if we look at the fair value price screen here, CFRA has a fair value price of 128, Morningstar 142, Fastgraph at 123, and Yahoo 154, and my dividend discount model analysis at 159. Averaging out the 5, we get a fair price of $141.46. Current price of 154. So basically it's saying that the company is overvalued based on my fair value price estimate of 8.3%. So it's overvalued, but this company is a great company. But with that, I have a hold recommendation at current prices. I love the long dividend history of 45 years, which is amazing. And the 10-year dividend growth rate of double digit, or 5-year dividend growth rate of double digit. The company is very diversified. They're into a whole bunch of products that we use every day and not aware of. Something that I really like is one of those simple companies that you don't, boring companies that continue to be profitable. But at current prices, I don't like the current price. I would like to see a 10% margin of safety. The payout also concerns me. It's pretty high, a little over 70%. So that's something to consider there. But I would like to see the company with a P of 17 and a half, maybe even under 18, before I can consider buying shares. But overall, the company is a great company, but at this price, I'm not buying, and that's why I have a hold recommendation. So thank you for watching, and if you have a company that you would like to see next, please let me know in the company name and ticker symbol in the comments below. Thank you for watching, and if you find this video informative, please hit the like button and subscribe to my channel for more videos like this. Don't forget to check out my portfolio and there's a link in the description below. Thank you and stay safe.